Welcome to another episode of Business by the Numbers. I'm your host, Hademris, CPA with Parmelis and Associates. So over the last couple of days, I've had a lot of clients reach out to me forecasting for 2025, and I've also been doing a lot of the same for my own business. So what better topic to talk about this week? How to forecast, what to forecast, and everything else in between is exactly what we're going to talk about this week. Before we get into that, I just want to stop and say thank you to you and the rest of the dedicated listeners. Remember, if you want to hear your question answered on here, just have a question for me, idea for future podcast, or want to be a guest, shoot me an email at podcast@parmelis.com. So just like a lot of episodes that we go down through, the whole idea behind this is forecasting, right? The title ensues this, setting goals for the upcoming year. But I want you guys to not only leave this with hopefully tools to allow you to forecast and set your own goals, but also the understanding behind this. Also, if you have the understanding behind this, it should hopefully maybe get you sometimes interested in something that you weren't interested in the past and kind of shows you of, yeah, this is going to be a little bit of work, but it's going to be worth it in the long run. So why do we forecast? A lot of things come to mind. You don't hit what you don't aim for, you can't monitor what you don't measure, and you can't be disappointed if you never set expectations. You all have something that you want to hit, right? You guys all have a number in the back of your mind, whether you've written it down, whether you just have a thought, a certain sales target, a certain profit target, a certain GP target, car count target. But yeah, what does that look like in a financial statement? That's all forecasting is, right? So if you think to yourself, well, hon, I'm not really sure. I forecast and I never, have in the past. I don't think it like that way. And you're sitting here thinking right now, you're going to close the year at $1 million. And if I asked you, well, what are you going to do next year? You'd say, hey, we're going to shoot for 1.2. That's forecasting, right? Now, in the most basic sense, but you're forecasting revenue. What we're going to be talking about here is, not only forecasting revenue like that, talking about of exporting these and forecasting a full financial statement, but as we'll talk about before, sometimes getting beyond the financial statements, right? Well, if I'm forecasting this number, what other metric has to change in order for this one to? This might sound very complicated, but what I'm trying to tell you is forecasting is just officially doing what you're kind of unofficially already doing for your business. Well, hey, I want 5 more cars a month next year. Okay, well, what does that look like in numbers, whether in sales, gross profit, productivity, etc.? You might be saying to yourself, well, Hunt, if I forecast what my financials are going to look like next year, what I think they're going to look like, and what that I would want them to look like if these certain KPI targets are hit, those are 2 different numbers. And that is exactly the crux of forecasting right there. That is the why we're doing this. The difference is where you're going to know that you're going to need to focus. Everything that's the same, hey, I can leave this section of my business alone, right? Rent expense can stay the same. Advertising is all fine, but my labor sales or my labor costs are different, and you just saw what you need to do. Right? If you look at this and say the difference between what I think I'm going to hit and what I want to hit is in labor, then you would need to look at your labor and say, all right, do I need to make changes? Do I need to hire a person? Do I need to let go of a person? Do they need to boost their productivity? Do I need to increase the labor rates? Right? This episode is not meant to tell you how to do any of this stuff. It is meant to show you what you need to highlight. How can you monitor something if you don't have any way to measure these results, right? How can you know if something is broken or something needs to be improved if you don't actually know what those numbers are? Now that you got the basic idea behind it, let's actually talk about how we do this stuff and what we look at. First and foremost here, and you can do forecasting for 5 years, for 10 years, for 1 month, for 1 week, right? But what we're talking about here in the most basic sense is an overall forecast for 2025. Unless 2025 is your first year in business, you have something to reference it, and it's this year. So going back to what we just talked about there is how different is your reality versus what you want your reality to be is going to go exactly into how we make this forecasting model. So you need to sit here and look at yourself and first and foremost say, how did this year go? You guys could be stopped right there because if you don't have good financials for this year, you're dead in the water. You cannot probably forecast accurately for next year because you're going to have too many variables and too many guesses. The less amount of variables that you can have for forecast, generally the more accurate it's considered. If you have no accurate financials right now, it's just a shot in the dark of what you're putting out there for next year. That's how important it is yeah, I know that you want next year to be better. And I know you're going to fix your financials for next year. At some point, you're going to have to probably clean up the financials so that you can get a baseline of where things stand right now. Why do we ask this, Hunt? Why does it matter where we stand and how different that is from the business that I have right now? So I'll tell you two reasons. The first is to set the overall stage, right? If your business that you want is very similar to the business that you think that you're going to have already, then you know you're probably not up for a whole lot of changes. Maybe it's not going to be a lot of friction. Maybe it's not going to be a lot of headaches or chaos. Now, if you're sitting this and the forecast is, 50% higher in sales than what you actually were forecasting to hit originally, then yeah, you know that you're in for some big changes. Also, like I said before, if you're forecasting and you're expecting 5%, 10% growth, 5, 10% changes in GP on this, I would say that it's something that can be pretty static. You can set these targets and within reason, it should come in pretty close to expectations. However, if you are forecasting or you're trying to change something 50% up, 60% down, that is something that you're probably going to have to tweak continually because it's just too big of swings. There's going to be too many variables to factor in one fell swoop. All of this might sound overwhelming. All of this might sound confusing. So you might be thinking to yourself, what should we be using, right? It's 2024. Should we be using software to do this? Should I be doing this on the back of a napkin? Should I be doing this in an Excel spreadsheet? Do whatever you're actually going to do and you're actually going to keep up with. I was actually going back and forth on how I was going to word this. And the biggest thing that I see is people overthink this, right? People go out and they get some sort of financial reporting software, forecasting. They go through all this trouble of trying to set budgets and make this forecast. And they lose the point of what it is, right? They're trying to work on this whole process when the end result is what we're shooting for, right? What is this forecast and how do we get there? If you've never done this before, don't go 0 to 1,000, right? Hey, just maybe basic top line sales. I'm going to set a sales target for next year and I'm going to break it down between monthly, weekly, and maybe daily sales target. I can do that on a calculator. I can do that on a sheet of paper. You say, Hunt, that's too basic for me. I need something more. Hey, go out and do a spreadsheet. You can export your current financials from QuickBooks into a spreadsheet. That's a basic template right there. You can do some growth trends on it, cut some expenses, add some expenses. That's level 2. If you're like one of my clients, and I'm not going to name names here, but I saw your spreadsheet before, some of these spreadsheets can get pretty big, right? Pretty complicated and can be a lot of work on that. Hey, maybe you're already past the spreadsheet and you want to go and look at a software. I was recommended this to my client before. I use a software called Fathom. Fathom does really good reporting, really good forecasting, budgeting, very similar to what you can get out of QuickBooks, just a lot more customizable. Do you need to be using Fathom? Do you need to be using Excel? Absolutely not. The more important thing is what you're doing, not what product you're using. Super tech savvy, love having all of the apps and it's going to make it more usable for you. Use Fathom. Hey, keep it old school and you want to just do it on pen and paper. It does not matter how you do this. It matters that you are. So again, I can't talk specifically because I don't know what your goals are, but we're going to kind of split this into, all right, what do I do next, into 2 different groups. One of the groups, and the first one we're going to talk to is, let's say that your target is pretty close to what you're doing now or what you expect to be doing, right? Not a massive change. The next one we'll talk about is when you're pretty far off or need to make some pretty big changes. The biggest thing that makes this a little bit easier is if you don't have a whole lot to change up or down in any really one category, then it's probably safe to assume that you have the correct head count, or if anything, you might be decreasing head count. Now, it's never easy to fire someone. You never want to look to decrease head count, but realistically, you can fire someone today. It is much harder to add someone than it is to fire them. So let's go for a pretty basic one, right? Maybe you're pretty happy with how the business is, and I get it. This is kind of hard on here, but I just want to kind of give you the conceptuals, not super important on the numbers. Let's say that 2024, we're doing, $1 million, $100,000 a month, 50% gross profit, 20% net income. So production is good, net income is good. You've hit that desired 20% net income that most shop owners shoot for. And you say to yourself, you know what, pretty happy with the way this is. Let's shoot for a 5% increase in sales. Because remember, if your sales do not go up at all from year to year, you're losing money. Unless prices start to fall and we actually see negative inflation or deflation, you can safely assume that your overhead cost of living is going to go up 3 to 5% every single year. So in this case, we're shooting for a 5% increase in sales just to keep up with our cost. if we're doing this, we say, hey, we want to kind of have a similar year to last year. What does this look like? Sales are going to be 5% higher. Gross profit is going to be similar margins. Overhead is going to be 5% higher. Net income should be relatively the same from a percent standpoint, but dollars and cents, a couple bucks higher because we have more sales. So how do you monitor this? And there is a limitless amount of KPIs that you could use to monitor this, but since we're not changing a whole lot of things, we're more or less looking for KPIs that stay similar, if not slightly increase or improve. So let's say that we want to do that 5% increase in top line sales. We know that we are selling hours here. We're selling people. And if we want a 5% increase, we either need to do 5% more work or we need to increase our prices 5%. So if you were going to do this on productivity increase, then you would look at your hours, look at what 5% more than last year was, and say, hey, if we averaged 100 hours a week last year, we need to average 105 hours a week this year. That's how we're going to get the 5% boost. That's what we can track. Now, if you know that you're going to increase your labor rate by 5% anyways, then maybe you just need to look at this and say, guys, we just need to maintain. We had 100 hours last year. We need to do the same 100 hours this year. Because we know if we do the same amount with our pricing increase, we're going to meet our target. Overall, like I said before, gross profit percentage should stay relatively similar. Maybe you're at 50 and you go to 51 or 51 into 52. There's no reason you would ever forecast a decrease in gross profit outside of significantly changing your business. Again, like we talked about before, overhead should stay relatively similar. So if I'm reviewing this, if I'm monitoring this, I'm looking at my overhead costs to be consistent. Like I said, increasing a little bit, but overall relatively similar. We know that if we are looking for a similar year to last year, and we have a 5% increase in our cost, 5% increase in our sales, bottom line from a relative sense should be very similar. Now, right now, we are doing a forecasting, right? So this is kind of a two-step process. The forecasting is setting that original target or the original forecast generally this year or early part of next year. And then what some people refer to as budgeting is what you're doing next year when you're actually monitoring this, right? You might think, well, I'm not actually budgeting how much I'm spending. No, but you're budgeting looking at actuals versus budgeted, right? If you were to look at this and say, hey, I expected a 5% increase, that's your budgeted amounts. Now, when you actually are looking at this for April, May, or June of next year, you can look it up at the actual amounts next to it and see where is this different. Are we doing better than what we were expecting? Are we doing worse, and why? What can we learn from this? What can we change? Do we need to change our process and procedure? Do we need to change our forecast, and everything in between? So another example being close, but maybe not as close as before, and one that maybe has a couple different layers to it is, and again, numbers aren't important here. The idea is behind it. But let's say you're trying to increase sales by 15%. Let's assume you have the work, you have the car count, you have the demand, but just didn't hit the right production numbers last year. So how do we get there? So if we know we need a 15% increase in top line sales, we know we're going to get 5% from the price increase like we talked about before. So if we look at this and say we need to do 15% more, rough numbers, we need to do 5% more just on pricing, which leaves us what we need to do about 10% more on production. So just like we were talking about before, a lot of different ways to do this, but I like to talk hours. So if I was a shop owner and I want to quantify what that 10% looks like, it all starts at hours, really. Sales are what ends up from these original hours. So if I take a look at my 2023 hours sold, I can divide that by 52. A lot of times I divide that by 50 though, kind of factoring in 2 weeks for holidays and stuff like that. But if I take the overall average and I divide it by 50 or 52, that gives me my weekly average for this year. Now, if I know I need to do 10% more, multiply that number times 1.1, and now I have my new weekly target for next year. Multiply times 4.3 times 12, right? You can look at this monthly, yearly. The overall idea here is you have a number in the back of your head, right? I want to increase this. I want to increase productivity. I want to increase labor sales. Okay, great, but quantify that. Well, I want to increase it by 15%. Okay, perfect, quantify that. You're going to do more? You're going to sell more? Well, we're going to sell more. Well, how much more? How many more hours? Forecasting and budgeting is all about taking what's intangible, what is in our head, and actually quantifying it in real life so that you can monitor this stuff so that you can see if you're actually hitting these goals. And if you're not hitting these, where and what we need to do to change this. If you are pretty close to where you stand, if you were kind of in those couple examples we just talked about there, this is something that you're always going to have to look at, you're always going to have to monitor, but you can probably set this target and more or less run similar course for all of the upcoming year. If you are in what this next category is very different, or, let's say more than 25, 30% change, you're not going to be able to set this and forget this, right? You're probably going to have to look at this quarterly to say, hey, am I not meeting my expectations, or do I need to change some assumptions because I wasn't factoring all of this stuff in here? What I mean by all this, keep an eye on this stuff. If you're in this category we're going to talk about right now, you're going to have to babysit this a bit more than others. Let's use the same example as above, but we are currently averaging 70 hours a week with 2 techs. So if we are currently averaging 70 hours a week, remember we were talking about before of hitting 100 or so hours a week, that is a pretty big increase, right? It's 30% less, but it would actually be 40% or more of a production increase on the labor side. The big thing here is we can look at this and you might say to yourself, well, Hunt, we're done right there, right? We are currently doing 70 hours. You said that we had the guys there. We have the work on there. They need to do 100. I'm going to tell them that and we're going to move on. The farther that you are away from your current targets to reality, the harder this might be. And like we talked about before, if you're really close, one of the biggest reasons of why this is easy is you probably do not need to add someone and you probably don't need to let go of someone. But if we use this example and we look at this and we say we have 2 guys and we know we need to be at 100 hours of production, that means we have 2 guys right now that are averaging 35 hours of production. So in order to meet that target, we need to either have those 2 guys overnight go to cranking out 50 hours of production a week each on average, or we need to add another team member. Every shop is different, and maybe you can go out there and maybe you can talk these guys into doing 15 hours more a week on average, but it's probably going to be unrealistic. Either way, you are now looking at the end result of saying, hey, I need to have a conversation with these guys in order to boost this production. Maybe you have the right team in place. Maybe it's that conversation that they need and they say, boss, we can do this. Great. Also, the same flip side of this, it's a good time to realize now of, hey, these guys are doing as much as they possibly can. And if I push them more, they might not hit it or the quality might suffer. And at that point, now you know, hey, if I want to hit this target, I probably need to add a person. Right? So all of this stuff is originally starting from the numbers, but hopefully kind of showing you, do I need to add someone? Do I need to let go of someone? Where do I need to spend some money? Where do I need to maybe cut some money? On the other side of this, maybe you look at this and say, Hunt, I already have the supply side, right? I got a kid starting this year. He's going to be able to pick up the extra slack. Remember, supply and demand. If you have an abundance of supply but no demand, you have a bunch of stuff that no one wants. If you have a bunch of demand and no supply, people are willing to pay a lot of money for something, but you don't have it, right? So you got to balance the two. Now, supply for us is on the labor side, right? It's the technicians supplying their hours in order to do the work. Now, we could have the best technicians in the world and all the capacity, but if we have no cars, we have no demand and we have no market to sell these in. Demand is 2 things. Demand is cars and demand is more demand for each cars, right? Average repair order. So if you're looking at this increase in sales, then you're going to have to say, hey, are we going to be able to sell more to our current customers, which means that we can keep our same car count and increase our average repair order? Or do we have to keep our average repair order the same and we're going to have to go out and find more customers? It's probably going to be a mixture of the two, and depending on where you are and what you're currently doing. But again, that's going to allow you to look at this and say, hey, we don't need to talk to our marketing company. We don't need to tell them we need to boost car count. We can do this internally with sales skills, processes, whatever it might be. On the same flip side, if you think that you have very good advisors on the counter and you look at the numbers, you might say, hey, I cannot get this 15% increase, this 30% increase from an ARO lift. I'm going to need more cars. How many cars do I need? 30% more than what we do right now. Now you can set targets not only for yourself, not only for your managers, but also your marketing company, right? They would love to be able to say, hey, you guys aren't meeting my expectations. Well, what are your expectations? And the same flip side is a lot of times people are like, well, hey, I want more cars. Well, quantify that, because 20 cars for you might be great. 20 cars for someone else might overwhelm them, depending on where you're at and how many more you need. Like I always say, how can you be disappointed in your team when they don't hit the goals that you failed to mention to them? In the same line of thinking, how can you be disappointed in your business to hit the standards that you wanted when you fail to actually quantify what those are? As always, please share with friends. If you have any questions, comments, ideas for future episodes, shoot me an email at podcast@parmelis.com. Thanks again for listening to the Aftermarket Radio Network. You can find all shows on aftermarketradionetwork.com and on your favorite podcast listening apps. So thanks again for joining me on Business by the Numbers. Stay safe, and I will talk to you all next week.